Thank you. 私のアバディーン・スタンダード・インベストメントニュースレターです。よろしくお願いします。Thank you very much for your time today, and I'm not sure how much time I have exactly, but I've got quite a number of slides that I thought I would go through to give you a sense, first of all, of the market context, the return, and also to talk about not only equity but also debt, because many investors only think of equity, but there is also a debt element to real estate, which is quite interesting. Just very quickly, Aberdeen Standard Investments, we manage about $70 billion of real estate globally. That's about 1,400 assets. We're part of a wider business managing $800 billion of assets across mainstream asset classes, including infrastructure. We have a presence here in Tokyo with 50 people covering everything from investments to client servicing. So I'd like to set the scene, first of all, by just looking at the global real estate universe. And if you look at numbers, over the last 5 years, there was about $3.7 trillion invested in the commercial real estate market. And that investable universe, the UK makes up around 7% of that, which is very material. But more importantly, of the amount invested over the last 5 years, the UK has received about 11% of that investment. So the UK is a very favorable market for investors. As a global asset manager, we invest in real estate all over the world, across many European countries, the UK, South America. We currently own an asset in Nihonbashi in Tokyo. And we are very fundamentally driven. So for us, it's very important to look at the risk and the cash flow. And I thought I would just share with you this global real estate model that we use to think about risk within markets. And this model really is a reminder that real estate is not simply about cash flow. It's also about completing transactions. It's about the legal system. It's about tax. And it's about transparency. And you'll see that Japan is relatively high there. But without doubt, the most liquid, transparent markets are the UK, the US, Germany, and France. And essentially what this really says is the UK is a very transparent market. It has a very clear legal system, and one can transact quickly. And we see this as an explanation for the higher percentage of allocation that the UK has received from global real estate flows. I said I would talk about return, and this just gives you an insight into how we see global real estate markets. In a moment, I will provide a slightly more detailed slide that will show you the range differentials for the UK in particular. But what this tries to do is just show for a very core, stable asset over the next 3 years, and not taking account of FX risk, where do we see the total return? And actually the UK is somewhere between 3.2 and up to about 7%, depending upon the type of asset and the region you're looking at. But that probably gives you a sense for global risk at the moment and return. Oh. Excuse me. Specifically on the UK, just going back to Tom's comment on the economy, we do a lot of fundamental analysis on GDP, political risk, and economic outlook. And real estate is ultimately highly correlated to the macroeconomic environment. We are of the view that returns will be stable in the UK for the next 3 years, but we're also of the view that the majority of that return will come through income. So if you are a long-term investor and either you are looking for income or you're willing to hold assets through real estate cycles, we see limited downside risk, albeit not substantial return over the next 3 years. It was mentioned earlier about the importance of international investors, and I don't want to focus a lot on central London, and I'm not going to. But I thought you would find this slide interesting, and this just highlights the complex nature, and it highlights the vast number of international investors that invest in central London and further afield in the UK. And you can see this only goes back to 2006. You can get data going further back, but you can see there's a diminishing hold from UK investors and also US investors, and we're seeing much more diversity in terms of the types of investors and the jurisdictions they come from. I just want to touch upon real estate risk premium. I mentioned somewhere between 3.2 and 7%. This is an example of a return that we looked at, about 5.5% total return for core plus commercial real estate in the UK. And the important thing I just want to mention here is that a lot of people are talking about Brexit and they're talking about the FX position. Well, actually, we come at it from a non-emotive perspective. We just want to know, does this make sense? And the long-run average return risk premium that we see, so the premium over the risk-free rate, taking account of depreciation and any rental growth, the long run is about 2%. And at the moment, we see the UK around 3.5%. So we still see significant value and room in the current market. And that's allowing for growth for government bond yields to rise as well. We talked, Tom talked a moment ago about broader markets, and in our first slide, there was a picture of our headquarters in Edinburgh, which one of our funds, developed, built, and is now occupied as of 2 months ago by about 2,000 members of staff. And I think this slide really is just to highlight to you that there is a broad market set. Tom mentioned some of the numbers earlier. We invest across regions and across asset classes within real estate. So shopping centres, hotels, logistics, and there is real breadth and depth across the marketplace. I think personally what's quite interesting is that the 2017 numbers were only 9 months of the year. And if you annualize those, it's been a very interesting year because we've seen continued investment and interest across the regions as well as central London, despite some of the volatility around Brexit. Just moving on, I'm just going to flick past a few slides because, as I say, I'm conscious of time. And I'd just like to draw this to your attention. This is our real estate house view. We release this every quarter. This is a 3-year view globally. It shows total return across markets on a local currency basis without taking into account tax. And I wanted to highlight on the left-hand side the differential within the market within the UK. And as you can see, when we say we're very heavy, that means that we're recommending to many of our fund managers to invest in some of these assets. So build to rent was mentioned earlier in the day, and also distribution and logistics. And we're very focused on that at the moment as a house. We are less focused on secondary, smaller retail outfits. We're less focused on inner London offices, and that's shown on the bottom left on very light. I think also from a broader global perspective, it shows just what a unique and diverse global real estate environment that actually is out there. Now, we have a very long history. I should have said at the beginning that we were founded in 1825, and we've been investing in UK real estate for many, many years. We've been investing in Europe since the 1970s. And I'm not going to dwell on this slide, but it just shows our market presence within London and many of the assets that we own. But I'd rather show you some of these assets. So this, just to give you a sense of two or three assets before I move on to the debt side. This is an asset that we bought in 2010 in the West End. We completely refurbished this asset. We have an in-house development team, resulted in creating larger space in the building, a better environment, and we increased the rent on that, as you can see, from 105 to 130 square foot. So we've had that for a number of years, but we ended up selling that actually after a 6-year hold. So that was a shorter term investment. Here is an asset that we built, we developed, and completed in 2009. Again, this is in the city. I'm just showing you a couple of London ones intentionally for the moment. And we still hold this asset. It's providing a return of about 12.8% per annum for our long-term investors, insurance companies and pension funds. And then finally, just another asset management proposition in Cheapside, very close to the Bank of England. We bought this in 2014, a brand new building, and we redeveloped some aspects of it, fully let that building in 2016. And again, that's provided a very interesting return for investors. Now, this isn't about our asset management capability. This is actually about the fact that there are opportunities out there from 30 million to well over 100 million for investors who are focused on commercial real estate opportunities. Just finally, it's very easy, I think, to talk about equity, and of course I've given a very quick overview and some very quick dynamics of a market which goes from core plus right through to value add and opportunistic. But it would be very remiss, not to be talking about debt. Before I moved to Tokyo, I built and fund managed our debt capability in the UK. And I also managed all of our real estate debt globally. So I used to transact debt transactions in Poland, Belgium, France, Italy, Spain. And what's interesting about this market, and it shows here, is essentially the cash return that you can obtain by lending against a building instead of buying the building. And in the UK, as with other global banking markets, that really goes from senior secured right through to mezzanine. To bring that to life, we do a lot of analysis on this. We have an internal rating model that looks at the loans so that we can compare them to more liquid investment grade investments. And on the left-hand side, this just shows you the margin over liquid bonds for lending a debt investment against real estate in the UK, particularly in the senior secured range. And what it therefore shows is the illiquidity premium that one could expect to have by making those investments. So still utilizing the asset and the cash flow, but not buying the physical building. And you can see there at the moment, you're looking at an illiquidity premium of somewhere around 200 basis points over an equivalently rated liquid corporate bond. And then just lastly, just to show you a couple of quick examples of that to try and bring it to life. This was a loan that we completed for our insurance parent company, Standard Life PLC. It was a loan of £120 million to a luxury hotel, privately owned company in London. It was a 10-year loan, so quite a bit of duration, providing an interest payment to the insurance company of 230 basis points over the 10-year gilt rate. And that had a confirmed rating of AA, so very strong investment grade, very low loan to value, and very low probability of default. On the flip side, this is a very different proposition going into the regions. This was a regional shopping centre loan that I was personally involved in. Lower level, this was only about 20 million sterling, so about 30 million US dollars. Much higher return, about 273 basis points over the 3-month prevailing LIBOR. And you can see that in the loan to value rating, so the amount of debt that was offered against the asset, and the underlying credit rating comes down from AA to single A. Tom, sorry, it was mentioned earlier that the debt market has been evolving and changing given the banking cycle, and Standard Life has been one of a number of entities that have stepped into that market to provide long-term financing to help developers and to help the real estate market. Just to sum up, I just want to show you one slide which just reaffirms that flow of capital that I mentioned at the beginning. Very first thing I mentioned was the split, the importance of America, Europe, including the UK, obviously, and Asia, and that $3.7 trillion. And I think I'll just leave you with this, which is the flow of capital into commercial real estate over the last 5 years. Huge business, huge opportunity, and it's been clear, as I said, that the UK has had a higher allocation of that global capital over that 5-year period. Arigato gozaimasu.